Sam Altman wants you to believe OpenAI is untouchable, the company that lit the fuse on the entire AI revolution and is now lining up the biggest stock market debut in history. But behind that showmanship, the walls are closing in. OpenAI just pushed back that listing because Altman is holding out for a $1 trillion price tag the market may simply refuse to pay. It's losing ground to an upstart rival, and it's been undercut from below by cheap Chinese models eating into its market. So, today we break down why that trillion-dollar dream keeps slipping, how OpenAI is bleeding the most profitable layer of its business, and why a wave of nearly free competitors could turn the king of AI into just another supplier. My name is Nick, and this is the Finance Bureau. Now, for most of the last 3 years, OpenAI was the only name that mattered when it came to artificial intelligence. ChatGPT became the fastest growing consumer product the world had ever seen, and Altman became the face of the whole movement. OpenAI was at the frontier. Everyone was playing catch-up, and investors were throwing money at it. In March 2026, the company closed a staggering $122 billion funding round, co-led by SoftBank, Amazon, and Nvidia, that set its private valuation at $852 billion. That's the kind of number that makes a public listing look like a formality. But the moment you try to take a company like this public, the story has to survive contact with the people who actually want their money back. And that is where the cracks start to show. OpenAI confidentially filed its draft paperwork with the SEC on June 8, 2026, in expectation of a debut later in the year. And then in late June, reports from the New York Times and Reuters revealed that the listing is now sliding towards 2027, thanks not to the vagaries of the market or the concerns about the speed of AI development, but to Altman himself. He is reportedly holding firm on a roughly $1 trillion valuation, and according to people familiar with the matter, anything lower is a non-starter. Now, let's put that into perspective. The last private round priced the company at $852 billion. So Altman is asking the public market to hand him an extra $148 billion in value before the bell even rings. His own advisors reportedly gave him a pretty straightforward choice between listing in 2026 at a number the market will accept, or waiting until 2027 and trying to grow that into $1 trillion. He chose to wait, and that may have been influenced to some degree by OpenAI's chief financial officer, Sarah Frier, who has reportedly pushed for the delay, warning the company isn't ready for the relentless glare of public market scrutiny while it is still burning cash at this scale. And when the bean counters are nervous, that tells you something. The prediction markets agree, by the way, with betting platform Kalshi currently putting the odds of a 2026 listing at only around a third. And the backdrop isn't helping either. The Nasdaq has fallen 5% over the past month, and other recent high-profile debuts have been brutal. Einride, the autonomous trucking firm, is down nearly 57% from where it opened, and even SpaceX, the largest listing in history, has slid almost 23% from its post-debut high. Investors are not in a generous mood, and Altman knows it. As one AI researcher, Gary Marcus, put it, there is no rational argument for buying a share of OpenAI at $1 trillion valuation. And it gets more uncomfortable, because while Altman is busy arguing about the price tag, a rival has slipped past him when it comes to actually paying the bills. And that rival is Anthropic, which, until recently, was very much the David to OpenAI's Goliath. ChatGPT is, after all, a household name, almost a shorthand term for AI in general, and a wildly successful consumer product. But according to a research firm Counterpoint Research, in the first quarter of 2026, Anthropic captured 31.4% of global large language model revenue, edging ahead of OpenAI's 29%. And that is the first time that OpenAI has been overtaken on this metric. And if you zoom into enterprise spending alone, the picture looks even worse. A separate report from Menlo Ventures put Anthropic at 40% of enterprise spending against OpenAI's 27%. Though it is worth flagging, Menlo is an investor in Anthropic, so take those figures with a pinch of salt. But the direction of travel, though, is not in dispute. So, why is this happening? One word: coding. Anthropic's Claude models have become the default for software engineering and so-called agentic work, which is just the industry's term for AI that carries out long, multi-step tasks on its own rather than answering one question at a time. And these are the highest value, stickiest jobs in the entire market. By early 2026, Anthropic's coding tool alone was running at $2.5 billion a year, and it was reportedly winning around 70% of head-to-head enterprise deals against OpenAI among new business clients. And the thing about enterprise is that once a company wires its workflows around one vendor's AI, ripping it out is very expensive and painful. And Anthropic is winning customers and building a moat at the level where it rarely hurts to leave. Now, to be fair, OpenAI is far from finished. ChatGPT crossed 1 billion monthly users in May 2026, a consumer reach Anthropic can only dream of. But consumer attention is the low-margin layer, while the high-margin enterprise layer is exactly the path that it's losing. And even on its home turf, the lead is thinning. ChatGPT's share of the AI assistant market has fallen below half for the first time to 46.4%, with Google and Anthropic gnawing away at the rest. But none of this would actually matter if OpenAI were a healthy, profitable machine that could simply absorb the pressure. But it isn't. In 2025, OpenAI reportedly generated about $13.07 billion in revenue, certainly impressive, until you consider that it burned through roughly $34 billion in costs. And that works out to roughly $2.6 spent for every single dollar earned. Now, you'll see a headline figure floating around of $38.5 billion net loss for the year. And I want to be clear here, because that number is misleading. The bulk of it, around $41.55 billion, is a one-off non-cash accounting charge tied to the company converting from a non-profit into a for-profit structure last October. It's just paper money, it's not actual real money that's walking out the door. The figure that actually matters is the operating loss, which came in at around $20.9 billion, with true cash burn estimated by the Financial Times at roughly $8 billion. Still gargantuan, but at least it's real. And the single biggest reason for that burn? Compute. OpenAI paid Microsoft an eye-watering $17.2 billion in 2025 alone, just for the computing power to train and run its models. This is the machine that has to be fed constantly, and it is ravenous. In the first 3 months of 2026, cash burn hit $3.7 billion, reportedly triple what it was a year earlier. And the future commitments are almost absurd. OpenAI has reportedly committed to spend around $665 billion in compute infrastructure through 2030, according to internal documents shown to shareholders. $665 billion for a company that is losing billions every quarter. And this is why OpenAI needs that conveyor belt of fresh capital just to stay standing, and why each new funding round has to be bigger than the last. Profitability, by the way, isn't expected until 2029 at the earliest. And by the way, if you're wondering how you can stay up to date with stories like this, which can ultimately affect your portfolio, then that's exactly what we cover in the Finance Bureau newsletter, where we break down the stories moving markets before they hit the mainstream. It's completely free, and you can sign up using the link in the description or by scanning this QR code on your screen. Now, back to the burn, because there's a second-order problem hiding inside it that's even more dangerous. And that mountain of spending only makes sense if OpenAI can charge a premium for being at the frontier. If its technology stays meaningfully ahead, customers pay up, and the economics eventually work. But what happens when the frontier stops being exclusive? That is the squeeze from below, and it's coming out of China. Over the past 18 months, a wave of Chinese open source models, DeepSeek, Alibaba's Qwen, Zhipu's GLM, and Moonshot's Kimi, have gone from curiosities to a genuine threat. And the price gap is pretty stark. These models are anywhere from 5 to 20 times cheaper per task than their Western counterparts. Pricing data shows top-tier Western models costing somewhere between $1.8 and $2.75 per task, while a model like DeepSeek comes in below 13 cents. And that pricing gap puts them in a completely different universe. Now, I'm sure there's many people object to that, saying surely they're worse. I mean, you get what you pay for, right? Well, increasingly, that's not the case. On one demanding coding benchmark, Zhipu's GLM 5.2 actually scored 62.1%, beating OpenAI's GPT 5.5 at 58.6%. On the broad measures, the gap has narrowed to single digits, with Chinese models sitting only a few points behind the most advanced Western models, perhaps 4 months in capability terms. But for a routine task, that gap is invisible, and companies have noticed. The clearest signal comes from OpenRouter, which is a platform that routes traffic to whichever model a business chooses. A year ago, the big three Western labs, OpenAI, Anthropic, and Google, accounted for around 72% of usage over there. By June 2026, that had collapsed to roughly 33%. DeepSeek's latest model alone now handles around 16% of all traffic on the platform. The migration is already happening. The AI startup Lindy moved all of its traffic to DeepSeek, with its chief executive describing the savings as a matter of survival. Coinbase reportedly halved its AI bill by defaulting its engineers to cheaper Chinese models for routine work. And here is the irony that really stings. Even Microsoft, OpenAI's single biggest investor, is reportedly evaluating a Chinese model to manage its own soaring cost of running its own AI features. When your landlord starts shopping for cheaper suppliers, the moat is in trouble. That is the existential threat. OpenAI's frontier lead, the thing that justifies all the spending, is being commoditized from underneath. And its only real defense is to cut prices, which crushes the margins on a business already drowning in losses. Meanwhile, the implications of this go far beyond OpenAI itself. If you hold an index fund, a pension, or a workplace retirement account, this affects your money whether you're an AI investor or not. The entire market rally of the last 2 years has leaned heavily on the belief that AI is an unstoppable winner-takes-all goldmine, and OpenAI is the keystone of that belief. If the keystone is priced at $1 trillion on a story rather than a balance sheet, and that story starts to wobble, the repricing doesn't stay contained. It ripples through Nvidia, through Microsoft, through every fund that bought the dream. And the people most exposed are not the insiders. I mean, look at SoftBank. When the IPO delay broke in late June, its shares dropped as much as 14% in a single session because it has a $40 billion bridge loan tied to that listing coming due in March 2027. SoftBank's CEO needs OpenAI to go public on time far more than OpenAI does. But of course, the early backers, the venture funds, the insiders, they got in at a fraction of today's price, and they have the optionality to get out. The everyday saver pulled in through a passive fund they never actually chose is the one left holding the most stretched valuation in the market if the music slows. So, who actually wins here? For now, the rival labs are sitting pretty. Anthropic is priced at $965 billion, and it has overtaken OpenAI on the layer that pays, and is reportedly heading for profit while OpenAI hemorrhages cash. The Chinese labs win by turning the frontier into a cheap commodity and pocketing the customers fleeing the premium. And the early insiders win because, well, they were early and they're insiders. The losers, if Altman's trillion-dollar bet misfires, are the ordinary investors holding the AI trade through funds they were told were safe and diversified. There's a lot riding on OpenAI's IPO when it does eventually come, and if it falls flat, then the fallout could hit hardest those people who never had any chance of investing early in the company and who've only ever used ChatGPT for restaurant recommendations. Any profits will go to the few, but the losses will get shared out amongst all of us. Stop me if you've heard this before. But what do you think? Can Sam Altman justify that trillion-dollar dream and grow it into 2027? Or does the market finally call the bluff, forcing a humbling debut that drags the rest of the AI trade down with it? Let me know your thoughts in the comments down below. And if you want to understand how the cost of building these AI models could break the wider market, then you can check out our video on that right over here. That's all from me today, though. Thank you guys very much for watching, and I'll see you in the next episode.